Welcome to the Economic Rockstar Podcast with your host, Frank Conway, connecting brilliant minds in economics and finance.
Hello and welcome back to another episode of the Economic Rockstar Podcast. This week's episode features Michael Covel, entrepreneur and author of 5 books including Trend Following, The Complete Turtle Trader and The Little Book of Trading, Trend Following Strategy for Big Winnings. Michael Covel is also the host of his own podcast, Trend Following Radio, which has over 7 million downloads and features amazing guests. And some of those guests have also featured on my own podcast, including Vernon Smith, Jack Schwager, Dan Ariely, John Cochran, Daniel Crosby and Campbell Harvey. When I started this podcast, one of my aims was to have Michael on the show, as I've read a number of his books and also watched his documentary called Broke. And I also use his website trendfollowing.com as a great resource of looking at trend following strategies and features the historical returns of trend followers like Don Capital and Jerry Parker, who use trend following or momentum trading to beat the markets. So in this week's episode, as you've guessed, we talk about trend following. If you've enjoyed this episode and if there's something else that you'd like to listen to in the Economic Rockstar back catalogue, I'd like to recommend episode 98 with Kirk Duplessis, where we discuss options trading, and Eugene Fama's episode 125 on the efficient market hypothesis. So as always, check out economicrockstar.com/podcasts to see this complete catalogue of back episodes, or visit economicrockstar.com/Michael Covel, Covel, in which you can check out the show notes with all the links, books and resources mentioned by Michael in this episode. And thanks again for your continued support by listening to each episode either from my website economicrockstar.com, from Apple Podcasts, and please support the show by rating and reviewing and even subscribing so you'll download the episode automatically and never miss one, or by just checking it out on Spotify, Stitcher Radio or any of your favourite podcast platforms. And thank you Carl Lurgan for a 5-star rating and review on Apple Podcasts. I really appreciate your review and comment, and I'm glad the podcast has helped you in some way. Again, if there's any other way in which you can support a podcast, well, why not check out patreon.com/economic rockstar and choose one of the levels in which you can support the show on a monthly basis, all for as little as $1 per month. And I'd like to give a big shout out to Dan McIntosh, who was this week's supporter of the podcast. Thank you so much for your pledge on Patreon. So enjoy this episode with Michael Covel.
A trend following trader does not know when he takes his signal if this is the start of a trend. A technical analysis guy might say, oh yes, this signal means that it will extend into a trend. Very, very different, so different to be kind of like, Mars and Earth. I mean, they're not even really related in my mind. The pitfalls, the pratfalls, all the things that can go wrong when you don't respect volatility, when you don't respect robustness, when you don't respect wild markets or the edges of a bell curve, when you don't respect these things and pretend that they don't exist, as you kind of hinted at a few minutes ago, well, eventually there's a reckoning. Hey.
Hello, Michael. How are you?
Good.
Welcome to the podcast, Michael. I'm very honored to have you. I've a number of your books. I've purchased them, I'd say it was about 12, 13 years ago, and dipping into trend following strategies. And it's something I'd love to talk to you about now, and also about your own work and your podcasts too.
Thank you for having me on. I appreciate it.
Recently, I had a guest, Eugene Fama, on the show, and we talked about the efficient market hypothesis. And I didn't really go into much on some of the anomalies, but one anomaly that he seemed to recognize that beats the market consistently throughout time is the momentum effect, which is another way of saying the trend following strategy. And we didn't get into it in much detail, so I'm hoping we'll talk about it in this episode, Michael.
Yeah, I actually caught that piece. I think that's the reason we connected. I caught somebody had emailed me a comment from your episode with him, and him giving source credit for finding momentum to a couple different academics, and one being a great trader, Cliff Asness. And so that just kind of struck me because I thought to myself, my gosh, trend following has been around for decades and decades and decades, and perhaps even longer. I mean, you look at people like Donchian and Livermore, and you look at some of the testing that some of the firms, even like AQR, has done, going back hundreds of years on trend following evidence. So I thought it was a little unusual that momentum was kind of being attached to a more recent time frame for kind of like locating it or finding it, when I feel fortunate to have been the quote biographer of trend following, and it sure looks like to me people have found it. The traders found it. It wasn't the academics that found it; it was the traders, and the traders didn't. They didn't write white papers; they just made money. So
I think that's what happens a lot, doesn't it, in the academic sector, is that once somebody publishes research on a particular strategy, for example, they get credited only because it's out there in the public domain. Whereas traders aren't going to reveal this type of information if they're successfully trading on it.
Well, I think they do reveal it to kind of throw the contrary view back at you. I think they reveal it in their performance data. For example, if we were to look at the performance track record of Dunn Capital, we can go all the way back to like the mid 1970s. We can look at every month of performance. That's terribly interesting information, considering that performance track record is generally correlated with the S&P index holding and buying at zero, and the differential between buying and holding Dunn Capital and buying and holding the S&P is like 6, 7, 8 times differential over the last 40 plus years. Now, that doesn't mean, my gosh, that's like the secret of the universe, but it's damn interesting. It's worth investigating, right?
Yeah. And it's one chart that, when I teach stuff on a momentum effect, and I somewhat deviate, it's probably not the best thing to say, but I do deviate into trend following. And I do show that chart on Dunn Capital just to show the successful returns of trend following compared to the benchmark like the S&P. And it's astounding to see that year-on-year growth. I know there's some drawdowns, there's significant drawdowns in certain periods, but holding on to that particular strategy seems to work overall for the likes of those trend followers.
Hasn't Buffett said that if you can't be in the market, if you're going to be in the market, you got to be able to take at least a 50% hit. And Buffett has shown that he can take those 50% hits. And a lot of buy and hold index type investors have taken those 50% hits. But trend following is the scarlet letter. So it becomes worse when it's a trading strategy versus an index strategy. But an index strategy, last I checked, is just another form of a systematic strategy as well. You said something about momentum, though, there at the top and connecting with FAMA. I think one of the interesting things also, too, is that, at least from my perspective, is that the academics have described 2 forms of momentum. This time series momentum, which I will call trend following, and this cross-sectional momentum, which think of as relative strength. I could be completely out of my mind here. Maybe I'm just not paying attention, but I've yet to see the track records of the pro traders, for example, that have put together the decade upon decade cross-sectional relative strength track records compared to the trend following track record. So it's interesting that the academics have laid out these 2 forms of momentum. And look, someone's probably going to call into your show and say, Covel's crazy. He doesn't know what he's talking about. I don't know if I'm completely crazy. I've just not seen the track records. And I think that's interesting, because are we really left with really one form of useful momentum that one can trade off and just another that looks great in the papers?
Before we move on, Michael, just in case we've confused some people with the way we started the conversation, maybe we should go back and ask the question, what is trend following? And why is it different to something like, or what are the differences between fundamental and technical analysis? And do you use one or both, or which strategy is preferred by those trend followers?
I was thinking about this question the other day, and something I was recording myself. What is trend following? Well, it's not fundamental analysis, because in fundamental analysis, the audience is going to recognize that. They're going to say, okay, what are all the economic variables that I can take into my system, so to speak? My system might just be me. I'm the decision maker. And, for example, I'm going to take in every variable that I possibly can take in on Tesla. And then I will use that information to then know when to supposedly buy and sell. And that's one perspective. The technical analysis perspective that most people would be familiar with, you can see this across Amazon and all the books, kind of similar to fundamental analysis in a way. You, instead of taking in all these economic variables, you take in variables that exist on the chart or purported variables. This could be a particular pattern or whatnot. And then you too use that information to say, okay, I'll buy here and sell here, meaning this particular chart wiggle predicts this will happen. And generally, both of these strategies are applied to individual markets. There might be many individual markets, but it's generally applied to individual markets with the hope that if you apply this strategy to one market, it will kind of work. Trend following is different. Trend following is more in the headspace of venture capital or, card counting with the MIT team, or this guy that I just read about the other day, the horse racing maestro that beat Hong Kong. That's more like, hey, let's find a positive mathematical expectation game and let's bet on it. So, for example, here's trend following in a nutshell. You start the year. You don't know what's going to happen in the year. And look, I'm not saying trend following has to start on day one of year one, but let's just say that's what the story is. Okay. And you've got a portfolio of markets you're going to follow, a very diverse portfolio of markets. And the reason you can follow this diverse portfolio of markets is because you have a common belief about these markets that they're all the same in one way. They're the same in their price movement. So every market has a price, and the trend following trader says, you know what? I don't really have to know anything about corn. I don't have to know anything about palladium. The S&P, not relevant to me. The price moves. So you start your year with looking at 30, 40, 50 markets, very diverse again. Could be currencies in there as well, agriculturals, energies. And you wait. You wait to see what's going to happen. You wait to see a market start to move to show some momentum. And when it does, you get on board. Those signals to get on board, many people might call it technical analysis, but it's different than what these classic technical analysis books would talk about. So you take that momentum signal, could be a breakout, a moving average, you get on board. And you hope the trade goes your way. You hope it goes to the moon. You don't have a clue if it's gonna, but that's what you hope. Now, if it doesn't, you don't know anything. If it goes the other way, you got to get out. A tight stop, take your loss. So not unlike venture capital, where if you're out in Silicon Valley on Sand Hill Road, you make 20 investments in 20 different companies, and 19 of them are small losses, and one of them takes off to become Google. It's the same thing with trend following. You start the year tracking these markets. You start to take positions. Corn takes off. You start to make a fortune in corn. You try to take some positions in currencies. They don't go your way. The small losses start to build up. The idea being with the trend following strategy is you're going to not be able to predict anything. You don't know what's going to happen, but you're going to keep taking these trades as your momentum starts to show. And at the end of that whole scenario, play it forward decades, you're looking at a situation where it could be 30 to 50% losers. But your winners, I'm sorry, more like 70% losers, and your winners are going to be more like 30 to 50%. So if you've got 30 to 50% winners, you've got to have a scenario where those winners are much larger. So again, with the strategy that I'm describing, trend following, if you're cutting your losses and you're letting your winners run, you're looking for that positive mathematical expectation. That's trend following in a nutshell. I hope that will resonate with your listeners. There's more that people can find out about, but that's it kind of conceptually.
Anyone can check on, say, Google Finance or Yahoo Finance and get a chart, a price chart, candlesticks, or it could be a line chart. But if they typed in, say, a 20 and a 50-day simple moving average, you could see those smooth lines over time where they might cross over, and that may indicate a buying or a possible buying or selling opportunity given the trend has began or the trend has ended. That's
more of a technical analysis view than a trend following view.
Yeah, like it's just to identify that trend, when to get in, when has the momentum started.
How do you identify the trend, though, until the trend is over? See, there's a difference between taking an entry signal and getting into something with no expectation that it will continue versus taking a signal and saying, this is the start of a trend. A trend following trader does not know when he takes his signal if this is the start of a trend. A technical analysis guy might say, oh, yes, this signal means that it will extend into a trend. Very, very different, so different to be kind of like, Mars and Earth. I mean, they're not even really related in my mind.
I've used, say, a combination of both before, where I used the bar charts of price action. and I waited for, say, a 12-week high, and I used weekly prices as opposed to daily prices to remove the noise in the markets. And when I saw that 12-week high and prices were somewhat rising and confirmed by an upward movement in the simple moving average lines, then and that price action was above the simple moving average trend or the trend line, then that was to me an entry signal. Sometimes it dipped back down, the prices fell down towards the moving average line, but I held on in order to expect that drawback or drawdown. And sometimes you see the
drawdown in trend following doesn't come from one market alone like that. Again, I would really say that what you're describing is more of a technical analysis approach. The drawdowns from a trend following approach come from trading this diverse set of markets where you're going to have 60, 70% losers, where you're taking many small losses. The many small losses in many markets is what ends up giving you the drawdown versus trading one market in isolation.
And usually what happens with that, even if it's not necessarily a drawdown for that individual trade, it tends to, that initial increase over the 12-week high, when it reached that 12-week high, a trend typically emerged for a number of months or even prolonged for, even in hindsight, if you look back on some of the charts that you would see, especially in today's environment or what's happened in the recent number of years, the large upward movement in prices. And obviously we have declines and testing certain levels. And again, I'm probably
it's going to depend on what market we're talking about too, because I would assume by the way you're talking about broad equity perspectives, broad stock market index perspectives, whereas the trend following approach is much wider than that. That's where if you're going to take an index approach, or even purportedly trend following on one market, I have disagreements with people about this and try to explain it from my perspective, but you don't end up with the correlation benefit. So trend following, as described across my world, has that benefit of no correlation to other typical strategies. And that's worth a lot of money.
Yeah. As a trend follower, ideally, you just don't want to know what the type of stock or commodity you're dealing with. You're just concentrating on the price action.
Well, you got to know in terms of like if it's futures contracts, you got to know the basics, right? You got to have all that stuff down for your sizing and everything. But yeah, your variable for decision making is price action. So I don't know. I sometimes hear people say they add fundamentals in, and I don't know how that works. I've not seen that formula, since most trend following traders that I'm aware of are very systematic in their approach. So if you're systematic, you have to think about it in terms of coding this. The more variables, how does that all work? It seems like if one believes in the notion of price action, it's all embedded in the price. So why not just trade the price? In fact, one way to think about this too, there's not much about trend following that has anything to do with the markets. It's kind of what you're saying, but it really doesn't have anything to do with the markets. It's really just trading data. I mean, it doesn't really have, there's no trend following trader that's got expertise in soybeans or currencies. They don't have those people in their shop. Maybe the marketing documents say today in 2018 that those people are in their shops. But, the track records were all built off price action.
And how important is psychology here, or human behavior? I suppose there are two different questions, but the psychology of a trend follower, would it be much different?
Well, if you look at the behavior, if you see behavior, behavior can be best, at least human behavior can be best talked about maybe in price action. So the price is just the sum total of all the different people out there with their different views and different behaviors all embedded in this price action. So that's really an interesting piece of insight. This is kind of like Daniel Kahneman 101. The trend following trader himself, well, if he can't stick to his rules, he's really not a trend following trader. So where does that leave us? That's like anything in life, right? If you don't have self-control, if there's no willpower, it doesn't really make a difference what you're doing. You're probably not going to execute what you thought you were going to execute. So I don't think it's necessarily the psychology part is necessarily unique to trend following. I think it's just for anybody that's trying to achieve something in their life, trying to make something happen. You got to stick with it where there's nothing there.
Michael, how did you get into this initially? I know I read on your about page I think it was your about page on your website that you had your MBA and you were looking into moving into the markets. And I think they suggested that the MBA wasn't good enough. I don't want to be saying something here now that is not correct.
Yeah, my undergraduate and graduate degree have nothing to do with what ended up happening in my life.
Okay. Which was what then?
And then one thing led to another. And I remember being in an interview, and I found myself there because I was originally inspired by Michael Lewis's Liar's Poker. I found myself in an interview in Salomon Brothers, in the old building that was knocked down on 9/11, up right across from their trading floor. And I was with a nice young lady who, there's a longer story about how I even got the interview, but a nice young lady who must have realized that somebody was being, that I was there as a favor to somebody else who had been very high up at Salomon that I had met. And so she basically starts asking me questions about, my physics background. That was pretty much the end of it right there. At that point in time in the mid 1990s, that was all the rage. If you had a physics background, you were going to be hired as a trader. If you didn't, forget it. And not too long after that meeting, I walked into a bookshop and I saw Wall Street's top 100 paid for the year. It was either number 35 or number 37 was this guy named Jerry Parker. And he was described as a young guy who was trained to be a trader. He was only using trend following methods. And so that just struck me. It's like, wow, okay, this guy's completely outside of Wall Street. Here, I was just in New York City. I was just at Salomon Brothers trading floor, like this huge trading floor made famous in Liar's Poker. I'm thinking this is the only way one can possibly have success. And then all of a sudden, I see this insight about this guy who is trained. And this was one of the original, quote, turtle traders. And that was just kind of the start down the rabbit hole for me, like a lot of steps that followed after that, try and dig that story up and unearth what was going on here. Because even though I confidently described to you what trend following is today, I can remember a long time ago where I had no idea what it was. And it was not something that was talked about a lot. It was something behind closed doors. And the people that were doing it didn't really want to share that insight. So it was an interesting journey to kind of crack that egg, so to speak. And to add to that 1.2, which kind of leads me to a point, I can understand why the academics didn't know about it. I mean, I did more digging and had more weird, opportune things happen to allow me to understand what was going on with this strategy than any academic could have ever had, because they're stuck on a university campus. No one's, traders that are making fortunes are not just showing up on academic campuses and telling the finance professors, hey, by the way, this is what we're doing. At least they weren't doing this, for a long stretch of time. Maybe things have changed.
And do you believe in the nature versus nurture debate when it comes to teaching somebody to trade? Because when Jerry Parker became one of those original turtle traders back in the 70s, was it under Richard Dennis?
Sure.
When he had that bet with, I forget the other guy who he bet with, that he believed in the nurture debate on how to teach somebody to trade. And he got the group, after advertising on I think it was the Wall Street Journal, he got the group together and he was able to teach them methods, trend following methods.
Yeah, I don't think there's any debate about nurture when it comes to just about anything in life. Nurture wins.
And it's about being in the environment as well. Being part of that environment.
Nurture and environment, I would say pretty much, I think maybe it's saying the same thing versus what somebody was born with, because people used to like to say, hey, this trader or this guy was born with this. But then if you go ahead and you do the homework and you find out actually what that person did, Mozart's a great example of this. Mozart, they say he's a child prodigy. He's just born with it. Not exactly. And there's a great academic out there who's done the work on this named Anders Ericsson, if people want to look him up. He's got a great book called Peak, and he dives into this notion of deliberate practice. This is what Malcolm Gladwell based his book on. And the notion of deliberate practice really is what makes the world run. So if you want to get ahead in something and you practice at it every damn day and you keep at it, you're going to end up being that person. I don't care what the discipline is. You'll end up being that person where everybody goes, oh, look at that guy. He's just Frank. He's just a natural talent. He just woke up with it. He was just born with it. That's kind of bullshit.
Mm. And like, have we ever seen anything like it since? I know there was a second round of Turtle Traders too. But have you seen any other experiment whereby, I'm sure there are experiments even in-house as well, but something that is available to people to the extent of getting random people from all walks of life or all disciplines. Are you aware of anything that's happened since then?
I'm not aware of anything like that. And I'm not so sure people want to repeat it because ultimately, if you had to really objectively look at it, did not Richard Dennis and his partner Bill Eckhart give away the store, so to speak? They basically trained all these young people to be traders who then went out and became hedge fund managers and collectively managed billions of dollars. So I don't think there's a lot of people that have spent their blood, sweat, and tears to create their fund or whatever it is necessarily want to just, from an altruistic standpoint, let strangers in the door and say, here, take my money, take my rules, go make a fortune, and I'll make less than you ultimately. So I think people really should give someone like Richard Dennis a round of applause for what he did. I don't know why anybody would necessarily repeat it. Mm. I mean, you can train people in-house, but why would you want to give them the keys to all of your hard work? So I'm not so sure that one will ever be repeated. And I think, too, that you have to look at it at a point in time. I mean, the internet essentially started 1994 when people first started really using email and the web a lot, and Netscape went public in the summer of 1995. So it's kind of before Netscape and after Netscape. And now we're in a place where, you know, everybody is online, connected, and secrets very difficult to keep. So, gosh, if Richard Dennis did an ad today, right? If people knew who Richard Dennis was, if he had the same level of fame that he had then in 1983 when he put this ad out, and he was as famous as George Soros at the time. I mean, they were kind of viewed as the two big guys, the two big traders. If they put that ad out today with Dennis having the level of fame that he had then, and then magnified across the internet, he got, thousands of responses in 1983? How many responses would Richard Dennis get in 2018? Hundreds of millions? A billion? How many people would respond to an ad like that?
I can only imagine, because there's...
Right?
Yeah.
It's crazy if you think about it. That's what's so interesting about the world. The world keeps changing, but while the world keeps changing, and we can just map out a little scenario like that, something like trend following keeps on keeping on, because from the ground up, a strategy like trend following adopts or adapts to whatever is taking place, because price action is, there's not two variables that you have to trade, a currency. It's one. You trade the price action. So they've not made it more complicated yet. So we luckily still have these market mechanisms, and I'm sure you talk about the markets and the best way that markets can operate on your show quite a bit. But as long as we have this market mechanism notion where people can gather, even if it's electronically, gather together to find a price discovery, I think we're going to continue to have, as long as Daniel Kahneman points out, as we kind of got these irrational things rolling around in our head, we're going to continue to have momentum.
And that's the thing. In economics, we developed this whole idea of a human as being a rational person. And a lot of the models are built on these rational perspectives. Yet there are errors, and these errors become quite pronounced in times of economic or stock market turmoil, where the irrational part of the human behavior dominate that type of price action. And it's unexplained through some of these models, but to a psychologist or a behavioral analyst, they recognize that these moves are due to the irrational behaviors, and the irrational perspective has always been present, but we just didn't pick up on it because we felt that it was rational behavior that was a dominant force in determining price actions.
That's one way to look at it. I think that's probably a fair assessment. Another assessment could be that on campuses, given to what the nature of a campus is, given the nature of academia, getting a PhD, getting published, I tend to think that a lot of the, quote, academics know what the holes are in their theories. They're not dumb people. They're a lot smarter than I am. They're a lot higher IQ than me. They're not dumb. But what we really got at play here is ego. And when ego is in play, people will do anything to protect that ego. If your entire reputation is built on something that's 99% true but 1% faulty, you just keep saying, hey, don't mind the 1%. That's not relevant. Just stay focused on the 99%. Even if it doesn't make sense to a 10-year-old, if you have really smart people, some of the highest IQs on the planet in academia, and their most important thing in their life is to protect their ego, well, they're sure as hell going to protect it.
And this is only good for these trend followers or other people who tend to trade against that type of rational thinking in the markets. Because that's effectively what they're doing. If you are, say, someone like a trend follower who is aware, or even someone who's a contrarian, who is aware of not necessarily the market moves, but is aware that the human irrational aspect of behavior will eventually become such a monster that they're going to be waiting for this price action to turn around and may end up shorting the marketplaces, knowing that eventually something like a crash could come about because people will fear this type of market and they'll want to sell out. And being a noise trader or whatever, however you might want to represent these people, or they could be smart money traders but not being aware of the turnaround in the markets because of the expected efficiency of them.
What if everybody is aware? Just to play devil's advocate, what if everybody is aware?
I think
that's a question.
Yeah, I think if everybody's aware, they might be afraid to make the first move just in case the market keeps on running.
But what if everybody is aware and there is an element of reputation protection? What if everybody is aware and for other motivations that have nothing to do with the right thing, that have everything to do with some other independent variable? It's not something that's often talked about, because I just want to assume that with a lot of the people that are involved in the field that you and I are talking about, again, they're some of the brightest people on the planet. You have to think that, it doesn't really make sense to kind of say that some of the smartest people in finance were not aware of something. How could you have not? Because how do you get the label of being one of the, wisest people out there? But then on the flip side, they just kind of like either didn't see like this huge obvious hole or just ignored it. It's a real kind of ironic type. It's a gap,
I know where you're coming from, actually. Yeah, you were making reference to, say, in academia, whereby people who come up with a particular theory or hypothesis, and it's generally accepted, but the awareness is that it's not something that could be used in reality. And if you end up trading or reacting based on this particular hypothesis, more than likely it won't come through for you. And I suppose one thing comes to mind is the Black-Scholes option pricing model with long-term capital management.
Yeah. I mean, and people today still talk about what a beautiful formula it was.
And I still teach it because it's on the curriculum.
But it's interesting. It's fascinating. It's very well done. It's elegant. But, what is this elegance thing? I don't know if this really has anything to do with, wild markets. Wild world markets not really tamed by elegance. But it bombed, huh? Once you kind of like view the world in that way, and the whole idea was, hey, we've now got this situation where we can apply massive leverage to make pennies, and it can't possibly go wrong, which, I mean, this is I don't want to walk into his lair because he's done so much good work with it. But this is Nassim Taleb's world. I mean, he's pointed out in much finer detail than I have the pitfalls, the pratfalls, all the things that can go wrong when you don't respect volatility, when you don't respect robustness, when you don't respect wild markets or the edges of a bell curve, when you don't respect these things and pretend that they don't exist, as you kind of hinted at a few minutes ago, well, eventually there's a reckoning. Now, when that reckoning happens, there's human nature again, because people want you, Frank, or me, Mike, they want us to tell them what's going to happen. Oh, we know this is going to happen. This is going to happen tomorrow. This is going to happen the next day. That's what people want. I'd love to, that'd be a great academic paper, speaking of academic papers, to figure out how that got started. How did we all become, people that are desiring to have P.T. Barnum tell us where the exit is every day? I mean, it's kind of quite wacky that as smart as the human body politic has become, in many ways we are not very smart, which goes back to your point about rationality and irrationality, right?
Mm. And I'm sure that's where the exit strategies are, or the exits are for traders, or targets, price targets. You see some companies like JP Morgan that are setting price targets for crude oil. And I don't know whether this is because they have self-interest in how those prices would materialize. But at times they could become self-fulfilling prophecies, or they could be somewhat lucky that the price has actually met their target. Like, I think every year CNBC does a competition and has their guests or viewers predict where the S&P is going to end up. And there's always one that is pretty accurate. And that's the nature of it, whether it's to do with luck. In that regard, it's to do with luck, and to repeat that over and over each year, you're not going to get it.
I'll throw something out about CNBC, which I've thought about recently. It's kind of outside the box since you bring it up. The faces on CNBC are the same for 20 years, right? So what do the programmers, I once was interviewed by CNBC for a position I didn't know it was an interview. They invited me up as a guest and paid for my travel, and I had no idea what they wanted, but it turned out they were trying to figure out content for a new show. I don't think they liked my answers. That did not cause me any lack of sleep or loss of sleep. But what's so interesting is, what do the programmers there know about having consistent faces? What does a consistent face on the most popular finance show do? What does that do to the end user that watches? When I see the Kernan or the Faber or the Kramer, when I see their faces day after day, month after month, year after year, decade after decade, what do they know about that? I mean, they know that people watch because they feel comfortable, and then they get advertising dollars, and people watch more or they watch less or whatever, but it's all based on advertising dollars. It's not based on, you, Mr. and Mrs. Public, making a good investing decision. It has nothing to do with that. These people on TV don't know you. They don't know your position. They don't know your perspective. They're just giving you what feels good to keep you watching. Right?
Yeah, that's right. And I can just visualize Jim Cramer's setup where he has these horns and bells, and when he's making bull calls or bear calls, and I don't know whether he still does that or not. Do you know what I'm on about?
I don't know. And we're not going into too much detail right now, but I've spent a lot of time in Asia in the last handful of years. And to some degree, that leaves you a little bit away from the maelstrom of everything. Of course, yes, I could still turn on CNBC and CNN and BBC at a drop of a hat, but I don't like to. It becomes this crazy noise machine, right? And it's really, this gets into the psychology of it, because people might be saying, "Hey, you guys are going off on a tangent. What does this have to do with trading? What does this have to do with trend following?" It has everything to do with it. The markets are just made up of people. That price action for crude oil that you just mentioned, that's made up by people. And people think that the market's going to go up, so they buy more. And if it keeps going up, they get worried because they've got a hedge, so they buy more. And it becomes indeed, a trend is a self-fulfilling prophecy until it stops. And then it goes the other way. So, okay, if we know that, whether it's crude oil or Swiss francs or the S&P, if we know these things can materialize from a flat position at any moment in time and start to move, well, how can we profit from these random moves in unrelated markets over time? That's the question, right? That question, if people really think about it, maybe they can listen to the show with me and you right now and they could say, I don't like Frank or I don't like Mike. Okay, don't like us. But honor that question. How can you take advantage of markets that are not connected, that are randomly moving? You can't predict when a trend might begin. You can't predict its duration. Now, how can you profit from that? That's a worthy question.
Can it be answered, or is it just that if you spot something?
Dunn Capital's track record answers it, right? Mm-hmm. That's what he's done. To me, I'd have said this on my own podcast, but his track record, to look at it, whether you're into trend following, whether you're into puzzles, whether you're into venture capital, whether you're into tech something, and puzzle is the right word, but his track record, to think about it, to reverse engineer it, that's a really interesting puzzle. And most people, look, you and I know most people don't know about the track record we're talking about. It's kind of I don't want to use the word obscure, but he's a fairly obscure trader who's made the company's made a bloody fortune over the last 40 plus years. Not as big as Tesla's fortune, not as big as Microsoft's fortune, but hey, we're in the billions. Who cares? It's still, it's still quite successful. But I think it'd be a great exercise for young and old alike that want to work on a financial puzzle, something that pretty much takes modern finance and throws it in the wastebasket. Go find that track record and reverse engineer it. And you've then thrown a hole in every finance textbook on every campus across this planet. That is fascinating. And everyone can do it themselves. They can just go figure this out, and maybe not everybody will figure it out, but I think most people can. It's going to take a little bit of work. It's going to take a little bit of, sweat equity, but you might just end up with an insight that nobody on your college campus was willing to tell you.
Of all the guests, Michael, that you've spoken to, and continuing on a conversation about being on campus, those students or academics being on campus and not being aware of alternatives to the thinking that is being discussed at campus. Of all the guests that you've had on the podcast, are they telling the same type of story? Like one of those guests is Jim Rogers that you've had, and we know Jim's recent history with George Soros betting against sterling back in the 90s. But I've also read a number of his books, and I think Jim is based in Singapore. And he wrote a book, I think it's to his children, and he suggested that the world is everyone's, be mobile. You don't settle in one country. Be mobile and move to another country when that country is experiencing prosperity. And I think he's based in Singapore because of that attitude. And he's quite flexible. And he's a successful trader in his own right.
Yeah, no, I mean, I've had Jim on my podcast several times. I've had a chance to go meet with him in Singapore, I think 3 or 4 times. And yeah, I can't say that we've got the exact same view on, let's say, market strategy, but in terms of the big picture, he is a guy that's trying to find big trends. He's contra to the masses, or at least he's trying to be. And I think he has an amazingly interesting geopolitical take on the world. The man knows a lot more about politics and government than I sure as hell do. And he's just a really interesting guy to listen to and talk with and learn from. Now, sometimes you might see Jim on a TV show and maybe he's only talking about the moment right now. But I think if people take a wider look, I still love his book. What was it? The Investment Biker.
Yes.
Driving around the world on his bike. I mean, so he's a terribly interesting guy. You were mentioning, though, the academics. You were mentioning the campuses. I'm not really sure if you were going this particular way, but I do find, since we've talked about some of the academic inconsistencies, I do find there are many academics, because you're talking about my podcast, many academics, because I go cross-discipline. I'll have people on from all walks of life. I just had a psychology professor on named Roy Baumeister, and Roy's entire career has really been based on studying willpower, self-control, and describing self-control, willpower as our greatest human strength. It like literally can change everything. And so there are academics out there that find their niche and they go down a rabbit hole and they give us great insights, things that we can walk away from with that is applicable for all of us. And we can just all take away and say, gosh, that's so interesting. Then there's other academics that really go down controversial paths that seem political or seem kind of more egotistical. And so I think it's an interesting thing to try and figure out which way someone has gone, right? So I've had most of my guests I have chosen very particularly for non-controversial type insights because I'm looking for evergreen. I'm looking for people that changed our understanding of how we as human beings operate, and that's fun to me because I get to be in school for the rest of my life.
And that's the important thing about being evergreen. Obviously, you'd like to take if there's changes to something that makes what you might have been aware of before, kind of put that in the past. But something that's evergreen just means that you can build up on that particular knowledge. And if something works, like, for example, Dunn Capital's track record, that's, you could say, evergreen, and a trend following is an evergreen strategy.
Yeah, I think you can say it's an evergreen strategy. I think you can say something like venture capital is. As long as you can, like, for example, if we're talking venture capital, you say, okay, Frank is a venture capitalist. Okay, as long as you can find a big enough winner to pay for the companies that all go default, then you can be successful over time, right? So that's the trick. Can you find enough big winners to pay for all those companies like Pets.com and eToys and sock puppets and all the crazy stuff that happened during the dot-com bubble? Can you find enough big ones, like Amazon, to pay for it all?
Michael, when I was looking at Bitcoin a number of years back, and we know the story of it now, the highs it's hit and the reversal it's made. But I remember looking at it, it must have been about $10, and I didn't buy. But I remember telling some students a number of years back that they should invest in it if they had any cash to purchase. Now, I don't know why I didn't do it. It's like you mentioned Taleb earlier on. It's like as if I didn't have skin in the game. But then it went to a high of something like 1,100 and back down to about 250 a number of years ago. I think it was only about a year and a half, 2 years ago when that happened. And it's something that I tried to apply a trend following or a momentum trade on, but it was sideways trading for quite a while. And I decided I'll wait until there was a breakout on the upside. But because I waited, I lost interest in tracking the price movement because there was no fundamentals I found that could be associated with what was driving prices up and down, except for maybe the scarcity of the Bitcoin, and also given that scarcity, the more people who wanted to purchase it, then the demand, if you wanted to think of simple economics, the supply and demand would cause that price to rise. However, it's only when prices began to hit, say, 2,500, that really, and it was the media that brought my attention back to Bitcoin, that I started to get, not stuck in, but I started to purchase a small bit here and there. And at a moment now, I think it's worth about $10,000, half the price, but it's after going back up again from a low of about 6.5, 7. Where do you stand with that, or how do you find?
Well, I mean, it's kind of like the beginning. It's kind of like the beginning of our conversation when I think you were applying technical analysis views to one market in isolation. So the only way I could have really made sense out of trading Bitcoin from a trend following perspective, if there was legitimately, 20, 30 Bitcoins, with an inside established markets, and you could then take positions not knowing which one would be the big winner. Bitcoin, until just the last few years, was really it. The others, Ethereum and Litecoin, they've made big runs now, but they really were very tiny. There was really just Bitcoin was the only game. And so I think the best way to think about Bitcoin is like, hey, if somebody had enough insight in it, this one market, and they believed in it, then I think buy and hold works better, because trend following is based on trading mini markets where you can't tell what's going to happen. So you end up with small losses in many of those markets, and then one takes off. So I don't know how the trend following mechanism gets applied to one market in isolation. I think that's just it's different than what I've been exposed to in my career.
And how are things in Asia, Michael? I didn't want to say Saigon. I let that out, but if it's okay, I know I asked you whereabouts were you in Asia, but I did a Google search afterwards, and you can see that you're in Saigon.
I'm sure at some point in time, right? At some point in time, here's my theory. We'll be, you and I, somebody like me and you will be having a conversation, and probably some geeks out there will have, geolocated us, and they will immediately they'll go online and rent a drone, right? It would be a drone you can rent remotely off the top of some roof, and that drone will geolocate Covel and find him and be looking in the video, be looking into the room when he's talking to somebody, right? This is where it's coming from, right? It's like, so there's not going to be any anonymity and no privacy. It's going to all be all gone unless we all walk around with V for Vendetta masks.
Yeah, and that sounds like a dystopian world, but unfortunately, I can see it happening. I never thought of it like that now, but yeah.
I never thought about renting a drone remotely from another city off the top of a building till now. I don't know if that service exists, but you can sure as hell control it remotely. So why not be able to rent these things? I'd like to take a drone for a ride in Saigon today. I'd like to take a drone for a ride today in Singapore. Just rent it online and go to town, right?
Yeah. Look,
Asia is amazing. Asia is amazing. Unfortunately, not many people that I grew up with have had the exposure that I've had. That's one of the reasons I enjoyed someone like a Jim Rogers, because when you come to Asia and you see the energy and you see the enthusiasm, this is across many countries, you're looking at countries that, were not ahead of England and France and Germany and the US. These are countries that were behind, and there's a lot of reasons why: population, desire to be rich. The middle class is only growing in Asia, and it will expand in the next 20, 30, 40 years in Asia by 100%. The middle class will not grow in the States. It will not grow in Europe. There is going to be one very, very wealthy corner of the world as we move into the next decades, and it's going to be Asia. And I just think to say otherwise is insane. It's fascinating to watch the starts and stops and the energy. It's intoxicating.
And there's plenty of opportunities there as well, I'm sure.
There is, but I got to say it's a little bit harder, and I can't blame people that were, if your home country is Vietnam or your home country is Singapore or China, you don't necessarily want the white guy from America named Covel to roll into your country and try and make all the money. I'm going to be second in line no matter what. That's the way it works. I'm okay with that. I'm very okay with that. I get how it works. I mean, if you take a look at Hong Kong and China and whatnot, I mean, you deal with colonial powers for a long time. Hey, look, you talk to Chinese for just a little bit. They're still not very happy about what the Brits did, and it was a long time ago. And that drives many countries, not necessarily in a bad way, but in a way where it's like, that's never going to happen to us again. We're going to excel. We're going to do really well. And, we're going to win. And I'm not really sure the West has wrapped their arms around that yet.
That just reminded me of a conversation I had last week with Loretta Napoleoni. I just released her episode there the other day. And she wrote a book on North Korea and how North Korea went into this totalitarian state because they had this idea of being colonized by Japan, and hence they became more inward and protecting their type of culture. And it's only now that their economy is starting to reach out and maybe develop more under the new leader. And actually, to be honest, you came up in that conversation, Michael, because Loretta was wondering why the stock markets haven't crashed 9 or 10 years later, given all what's happening politically and economically regarding, say, trade wars. And I just suggested that maybe I'll ask Michael when he comes on, because perhaps it's to do with, say, price action and maybe not necessarily what we might believe as an academic, could be causal factors for a stock market crash that hasn't materialized just yet.
Wow, we can't. You probably know as we're having this conversation, trying to say why something. Yeah. It could go straight up from here for the next 50 years. Who knows? Now there might be ups and downs along the way, but the thing is have we? And this would be where people that are kind of anti-trend following traders or critics of trend following, they say, Covel, he's drank some Kool-Aid, he's just trend following all the way. It's not really that. It's really more, is Daniel Kahneman wrong, right? Is Daniel Kahneman really wrong about people? And if people understand his work and then just look around at their friends and family, like, come on, man, people are people. People are crazy. And people want things rationally one day and irrationally the next day. And as long as that continues, there's going to be an opportunity for big moves, trends, to appear out of flat horizons that people can take advantage of to make money. I don't care what the field is, whether you're counting cards at Vegas and Macau, or whether you're at the trading table, or whether you're freaking VC, or whether you're horse racing and betting in Hong Kong. It's all the same stuff.
Michael, can I ask you a couple of quick-fire questions before we wrap up, if you're okay with that?
Yeah, sure.
To be honest, I have 3 of your books that I purchased over 10 years ago, Trend Following, The Complete Turtle Trader, and The Little Book of Trading. I lent out 2 of those to somebody about, I think it was about 9 years ago, and I never got them back. I think they were that good, they held on to them. And I also purchased your documentary, Broke, again around that 10, 11 years ago. Is there any book that you'd like to recommend? I know you mentioned Liar's Poker earlier on, and if that's your recommended book, fine, perfect. It is a great book. But is there any a book that you'd like to recommend somebody? I recommend your 3, the ones I just mentioned. I'll put the links up on my website. Or they can. Yeah, but
I would also say that too. My newest edition of Trend Following just came out in the last year.
That's the Black Swan edition, is it?
It's blue. There's no Black Swan on the front. It's blue cover, solid blue. I doubled the content. The content went from 100,000 words to 220,000 words. Wow. Basically rewrote the book. So that is highly recommended. In terms of just thoughts, I do recommend. I mentioned Peak by Anders Ericsson. Daniel Kahneman's Thinking Fast and Slow, and a couple good classics that people might think immediately pigeonhole me, but I really don't care because they're great books for at least a one-time read in your life, and that would be Ayn Rand's The Fountainhead and Atlas Shrugged.
I should have guessed because I think I saw that on your website, actually, The Fountainhead.
Yeah, some stuff just doesn't get old. I mean, I don't know how she saw it all. I don't know how she kind of versed it all over 50 years ago, but she did. She's brilliant, and I just don't know really how most people can argue with her perspectives, whether they're on the political left or political right. I mean, she's just right. She's just got it down. She figured it out.
I must read it because it's been, I've heard of the book a lot, and I've never sat down to read. And to be honest, I even have Thinking Fast and Slow. I've had that for 4 years, and I haven't even opened it up to read.
There's another one too that a guy I had on my show recently. His name is Brian Christian, Algorithms to Live By. Very interesting that coding and doing good code, writing good code, there is a lot of similarities between trend following. I'm not going to try and explain those all now or give those away, but that's another discipline that when you kind of just look at it, it's like, God, this sounds just like trend following. It really does. He did a great job with that book.
Oh, check that out. If there's time travel was possible and you can step into the DeLorean, what era would you like to go back to and who would you like to meet?
I've never been asked that question. I'm thinking about it. I don't think I want to meet anybody, but I do know what time frame I want to go back to.
Yeah.
Jurassic. There won't be anybody to meet, but that'd be a hell of a lot more interesting to see the Jurassic period, to see all of those great dinosaurs in person. That's much more interesting to me than anybody I could possibly meet.
Isn't it amazing that period actually existed, that those animals roamed our earth?
Yeah. That's why I want to go there. I don't want to go back and talk to some dude in Rome or talk to Einstein. I'm not smart enough to talk to Einstein, but I can go look at dinosaurs. That'd be fun.
One of my modules, when I teach it to some students, I forget what topic it is, to be honest, but when we look at outliers and try to explain outliers, perhaps like the black swan event, that's what I was really getting at, that it only takes one black swan to rid the hypothesis that all swans are white. But I suggested, what if there was another planet out there and these monsters were roaming around the planet and they were just ripping the heads off each other? And students just kind of look at me as if I'm a bit crazy. And he goes, well, Earth was like that a long time ago in the Jurassic period. You know, we have evidence of that with those fossils. So why not another planet? Why can't another planet exist out there that has those Earth-like properties?
Well, sure. We're in a simulation to begin with. So whoever coded us could have surely coded another system, or maybe they just decided to code this little particular universe for this little group of people on the planet Earth. You know, one day some people will actually wake up out of the simulation and then they'll find out that it was like there's an old Twilight Zone episode. Two people are running around like this empty dystopian town, and there's no one in the town, and they can't find anybody, and they're kind of all of a sudden at the end of it, like this big hand comes out of the sky to pick up these two adults that are on the street looking up to the sky, just cowering. This hand comes down and picks them up, and then you see it's like a small child, you know, holding these two earthlings, and the mother walks into the room and says, "Oh, honey, don't hurt those earthlings. Your father just brought them back for us."
I think I might have seen that. That's like about 30 years ago or something, was it?
You better get your dates right. 30 years ago. Come on. I think we're back in the 60s. It's longer than that.
Oh, well, I must have been watching repeats then at midnight. Michael, before we leave, is there any advice or perhaps any last words that you'd like to say to the listeners, whether they're academics or students or whoever is listening to this from a non-economics or trading background?
Yeah. Don't go try and find a job. Don't join a corporation. You've got the internet at your disposal. You have people around the world that want to buy. Find something they want to buy from you and sell it to them. Be the boss. You go through life being the boss, not because of some big ego thing, but if you go through life being the boss, you have a much more pleasant life. If you want to spend most of your life, and I know a lot of people want to do this, so they can yell at me and scream at me, but if you want to spend most of your life saying, yes, sir, to an asshole, you can do that. I'm just saying it's not the best plan.
And I'm going to mention this person's name, Joe. This is for you because I had a former student ask me last week, what should he do? He's working in a coffee shop and he loves, well, I don't know if he loves the whole production of coffee, but he wants to go back and do his master's. And I said, for what? And he goes, well, I always wanted to do my master's. And what do you want to do it in? Well, HR. And I said, okay, so it's just kind of like a signaling effect. And he said, yeah. And he goes, why don't you go and do something different, something that you might be passionate about? Maybe learn how to roast coffee beans. Work your way towards that type of skill. And if it's coffee you love, or, you know, the production of coffee or the serving of coffee, well, maybe work to that. And, you know, that could be better than maybe furthering your education.
Peer pressure, family pressure, lots of reasons why everybody does the same thing year after year, decade after decade.
You know what
standing outside the box is not easy.
Yeah. Like I love these people who have these unique skills like forging metals and coming from the traditional backgrounds of maybe Japanese, that type of thing. Something that's not picked up on in the educational system, but learned outside, where you have developed a passion and you just know that person either has gone into that accidentally, but has actually developed a love and a skill for something that's quite unique. That may not bring them riches, but it might make a more fulfilled life.
Can't disagree with you. Sounds like a plan.
Michael, thanks very much, and always appreciate it. And I'd like to say that you are an economic rock star.
Thanks, Frank. I literally cannot see. The rain is coming down so hard right now, you cannot see, but probably 50 meters. And I'm on the 20th floor of a condo right now.
Oh my God. I can actually hear the rain. Fantastic. Look, enjoy.
Okay, take care, man.
You too. All the best. Talk to you then. Bye.
Bye-bye.
Economic Rockstar is a free podcast that does not exclude anyone from listening as long as they have a device to listen, download or stream. I have many listeners from all parts of the world, and I truly am pleased to know that the Economic Rockstar podcast unites all of you through the common theme of economics. I strive to commit to releasing an episode each week and aim to develop Economic Rockstar into much more than just a podcast. Patreon is a platform that gives you, the listener of the Economic Rockstar podcast, the opportunity to express your appreciation of the show by committing a financial reward for as little as $1 a month. Patreon allows me, the creator of the Economic Rockstar podcast, to be rewarded and paid by you so I can continue with the running costs of the show and to reinvest and expand the podcast into other platforms or mediums in the future. To find out more on how you can help the Economic Rockstar podcast and have your name added to the supporters list on my website, please check out my Patreon page at patreon.com/Economic Rockstar or visit the supporters page on the Economic Rockstar website. If you enjoyed this podcast, why not leave some feedback or comments on the show notes page on economicrockstar.com, where you can also sign up and be a member of the Economic Rockstar community. If you're listening to this episode on iTunes or Stitcher Radio, I would love to have some feedback and for you to leave an honest rating and review, as this will help with the rankings of the show so that more people can find it. If you're listening on the website economicrockstar.com, make sure you check out the back catalogue of all previous episodes and interviews with some amazing professors and authors at economicrockstar.com/podcasts. Thanks for listening, and I really appreciate your loyal support. I know how much you love audio, so why not get a free audiobook with Economic Rockstar today? I've teamed up with audiobooks.com to bring you this amazing offer. Visit audiobooks.com/rockstar to download your free audiobook now.